Hello everyone, and welcome to another AmCham China video podcast on doing business in China. Today I'm here with Ines Liu of Deza & Shira, which offers a wide array of business consulting services. Today we will be discussing accounting and tax compliance in China. So Ines, perhaps we could start with accounting requirements. It would also be great if you could give us a brief introduction of the differences that many Western companies may find.
Hi everyone, it's good to be here to share our thoughts on the topic. We normally tell our client that typically differences they should note for their China operation on the financial side are the accounting practice, tax planning and compliance, foreign exchange controls, as well as annual compliance requirements. For all foreign invested enterprises in China, including wholly foreign owned enterprises, joint ventures, and representative offices, accounting work has to be in compliance with accounting standards for business enterprises, which we normally refer to as China GAAP, General Accepted Accounting Principle. China GAAP is today very similar to IFRS, only some minor discrepancies with a 90 to 95% conversion between the two standards. In contrast, US GAAP is significantly different from both China GAAP and IFRS. It is impossible to analyze the total differences between China GAAP and the US GAAP in a brief way. So let's take a closer look at a specific area where the requirements of China GAAP may differ from the application of the US GAAP in practice. On fiscal year, you need to pay attention to the accounting year in China, which must be from 1st of January to 31st December, and it may not be the same as your group reporting package. Bookkeeping-based currency. Under Chinese accounting law, renminbi has to be the recording currency for the purposes of bookkeeping and presenting financial statements. Foreign currency may be used as a bookkeeping currency for enterprises which conduct transactions mainly in foreign currency. However, for foreign currency transactions are to be converted into RMB when financial statements are prepared and submitted. Charts of accounts. In China, the charts of accounts is set and fixed by accounting system for business enterprises. However, enterprises can set up sub-accounts according to their own requirements. Reporting language. All accounts and financial statements shall be prepared in Chinese according to Tax Bureau's requirements. However, enterprises can prepare their accounts in English according to management requirements. Accounting software. The company should choose accounting software which meets all China local requirements. Monthly closing and voucher maintenance. At month's end, after accounts closing, no changes can be made to the previous months, and all recording vouchers shall be bounded together in time sequences with original receipts stick with the recording voucher. At the year end, accounting vouchers shall be bound and maintained properly for annual audit. Tax invoices. In China, for bookkeeping purpose, all invoices obtained from suppliers shall be official invoices, which we call fapiao, issued by Tax Bureau. Meanwhile, if enterprise needs to provide invoices to customers, the invoice has to be purchased from Tax Bureau.
So tell me, Ines, you just mentioned fapiao. How does the fapiao differ from a receipt that you might use in the US, for example?
For those new to China, the fapiao system can be especially confusing part of domestic bookkeeping. In China, all business transactions are required by law to be recorded on an official receipt or fapiao in Chinese. Contrary to other countries, fapiaos are more than just ordinary receipt. Fapiaos are distributed and administrated by tax authorities, and taxpayers are required to purchase the fapiao they need from the tax authorities according to their business scope. Fapiaos are physically paper invoices printed with a special printer by specially trained and qualified employees of the companies that have achieved general taxpayers. Please also note here that small-scale taxpayers can issue FAPIao as well, but they need to purchase FAPIao at the tax bureau. So now we can move on to taxes. In general, the primary corporate tax in China will be corporate income tax and value-added tax. Corporate income tax, simply put, companies that obtain income from or generate income in China are corporate income taxpayers. CIT is applied at 25% flat rate for regular enterprises. And the VAT is taxed on transaction and applies to on nearly every business transaction not specifically exempted or excluded. The tax rate may vary depending on the type of transaction, ranging from 0% to 17%. So in general, small-scale VAT taxpayers are taxed a flat rate on all turnover and cannot use input VAT credits to offset their output VAT. General VAT taxpayers, on the other hand, will also be taxed on all turnover. However, general VAT taxpayers' rates will vary depending on the type of goods or of service involved. As we have mentioned previously, there are several forms of legal vehicles for foreign enterprises. A representative office of a foreign enterprise, a wholly foreign-owned enterprise, or a joint venture. For an RO in China, the entity will be treated as a co-sender by the overseas headquarters, and therefore the tax structures will be fairly simple, though there are a few ways in which the tax obligations of an RO can be calculated. The most common way is on cost-plus basis, meaning the RO will tax on a percentage of its total expenses. After VAT reform, there is no business tax imposed on in this sense. The primary corporate taxes for an RO will be CIT and the VAT. However, the tax authority hasn't announced the applicable VAT rates for RO and related policies. In previous circumstances, the effective tax rate for an RO is taxed at roughly at 11.5%. Both CIT and the VAT for an RO will be filed and paid on a quarterly basis. For a WFOE or JV in China, because there's more flexibility in the permissible business scope of the entity, the tax structure options are greater than that of an RO. However, in general, the primary taxes will be CIT and the VAT. 25% CIT on gross profits will be filed and prepaid on a quarterly basis, with final payment or refund due after the annual tax reconciliation, and the VAT will be filed and paid on a monthly basis. Please also note that different taxpayers have different VAT tax rates.
Yeah, I've heard something about these different types of tax rates. I see you've got a slide coming up about it now.
Oh, yeah, there are two types of VAT taxpayers in China. As we mentioned before, small-scale VAT taxpayer and general VAT taxpayers. And the VAT taxpayers in China will automatically be small-scale VAT taxpayers until filing for general VAT taxpayer. A company is free to decide when they would like to file to become a general VAT taxpayer. For instance, doing so when the company is incorporated or at a later date. Once you become a general taxpayer, you can switch back to small scale. However, a company should keep in mind that once annual taxable sales exceeded the annual taxable sales ceiling, the company will be required to file for general VAT taxpayer status. Applicable sales ceilings differs by the type of industry the company is in. Here, the important distinction is that general VAT taxpayer can issue VAT special FAPIaos and are eligible to use input VAT to offset output VAT, which is the key to lightening the potential heavy burden of the VAT. In order to obtain input VAT credits to offset output VAT, a company will need to obtain a special VAT 发票 from the counterparty for the input goods or service. Conversely, a company's customers in China may also request special VAT 发票 from the companies for the same purposes. So in this sense, a company should carefully consider the intended business model in China and how 发票 would be used in this model before choosing an investment vehicles and taxpayer status. As typically, only a WFOE or a joint venture that is a general VAT taxpayers can issue these special VAT 发票.
So when it comes to VAT, I know a lot of people have been talking about VAT reform recently. Could you explain a little bit more about what that is?
Yeah, sure. The reform merged business tax with VAT starting in 2012 as a trial program, expanded nationwide to transportation industries and the modern service sectors in 2013. Later on, in the end of 2013, the reform was further expanded to the railway, transportation, and postal service industries. And from June 1st to 2014, to the telecommunications service industry, and now fully extended to include financial services, construction, real estate, and lifestyle services such as food, catering, and accommodation, etc. From May 1st to 2016.
And are we expecting any more reforms in the future?
The reform is totally completed now. VAT has fully replaced business tax. So far, no more in this regard, but it may take longer time to implement.
Okay.
Moving on to the foreign exchange. China has strict controls that will affect the company's daily financial transaction and cash flow planning, which needs to be dealt with carefully. According to the requirements of the State Administration of Foreign Exchange, SAFE, banks are required to open a special foreign exchange account for each client who has foreign exchange capital injection or income and payment. So when enterprises receive or pay out foreign exchange, they have to report the transaction nature to the bank and fill in the form to declare the transaction code, which indicate the transaction nature. This information is required by a bank to proceed with the transaction. Foreign exchange payment. Normally when enterprises have foreign exchange payment, it needs to provide relevant supporting documents to banks such as original contract, service invoices, tax payment receipts, tax clearance certificate. For direct foreign currency payment through capital account or conversion for more than $50,000 a disbursement sheet and verified invoices should be submitted to the bank before payment. And for conversion not exceeding $50,000 a disbursement sheet and verified invoices are not required. However, such conversion cannot be more than twice per month. Moreover, when the total payment, including conversion, reach to 95% of total capital amount, the bank must verify the invoices relating to the prior payment. Basically, it takes much longer time and effort to process an overseas payment than an RMB transaction, and it involves withholding tax issue as well sometimes. So companies should give enough lead time and pay special attention to foreign exchange transactions.
So because of these controls, do foreign companies have problems repatriating their profits?
I wouldn't say that they have problem repatriating their profits, but as all foreign exchange transactions in and out China are subject to strict control by the State's Administration of Foreign Exchange. So there are some rules and regulations that a foreign company needs to follow. Previously, when remitting more than $30,000 in funds abroad, banks require the provision of tax clearance certificate to prove that the correct amount of taxes has been paid before the funds can be remitted abroad. However, this requirement was canceled in July 2013. Instead, individuals and institutions in China making outbound payments the value of which is the equivalent of more than 50,000 US dollar, are now required to conduct record filing with the in-charge local offices of the State Tax Bureau. Foreign investors reinvesting in China with income legally obtained from their direct investment in China is an amount that is the equivalent of more than 50,000 US dollar, also need to complete a filing. Finally, let's talk about compliance. Each year of company, be it an RO, WFOE, or JV, will need to make sure they meet China's annual compliance requirement. Annual compliance requirements and the related time frame differ in terms of type of company. Let's start with WFOE and joint venture. So for WFOE and joint venture, the annual compliance requirements will be similar, and reporting to the previous year will typically take place in the spring of the following year. The first step is the annual compliance process will be to conduct a statutory annual audit report consisting of a balance sheet and income statement and a cash flow statement. This annual audit report will need to meet Chinese financial and accounting standards, including proper use of China GAAP, and it will need to be conducted by an external licensed accounting firms and assigned by a certified public accounting CPA registered in China. It's important to know that audit report requirements vary by regions. For instance, in Shanghai, companies must include a taxable income adjustment sheet in the audit report, but this is not required in Hangzhou, Beijing, and Shenzhen. In general, the audit procedure takes about 2 months, and audit report should typically be completed before the end of April in order to allow time for the company to meet the May 31st tax reconciliation deadline. The second step is CIT reconciliation. Though CIT is prepaid on a quarterly basis in accordance with the figures shown in the accounting books of the company, due to discrepancies between China accounting standards and tax laws, the actual CIT taxable income is usually different from the total profits shown in accounting books. Such companies will need to submit an annual CIT reconciliation report by May 31st to determine if all tax liabilities have been met and whether the company needs to pay supplementary tax or apply for a tax reimbursement. In general, the annual CIT reconciliation report will include adjustment sheets to bridge the discrepancies between tax laws and accounting standards. Companies that conduct frequently related party transactions should also prepare an annual affiliated transaction report on transfer pricing issues as supplementary documents to the annual CIT reconciliation report. Companies in certain regions will also need to engage a certified tax agent firm in China to prepare another separate CIT audit report. The third step is annual reporting. During the annual compliance process, companies will also need to submit an annual report to the Company Registration Authority, the Administration of Industry of Commerce, AIC, and before June 30. This AIC annual report will need to include information and updates on various companies' registration information, ranging from companies' domicile information to registered capital and shareholder information. The first step is foreign exchange existing right declaration. Because foreign exchange transactions in and out of China are strictly controlled by State Administration of Foreign Exchange, all foreign companies will be required to make an existing right registration with SAFE before September 30. This existing right registration will, in general, be an equity movement report comprised of various materials. The last step is combinative reporting. Additionally, before June 30th, companies will also need to submit a single accommodative annual report to the Ministry of Commerce, Ministry of Finance, State Administration of Taxation, and the National Bureau of Statistics. Unlike the previous required annual inspection, annual reporting only allows the government bureaus take on the role of supervisors rather than judges. They no longer have the right to disapprove reports that are submitted, as they can only suggest that the company make modifications. RO, for an RO, the annual audit and the compliance requirements will be a bit simpler than for a WFOE or joint venture. Similar to a WFOE or joint venture, an RO will also need to conduct an annual audit report prepared by external licensed accounting firms and signed by a certified public accountant registered in China. Additionally, ROs will need to submit an annual taxation consolidation report to the Tax Bureau before May 31st. Although regional variations may exist, if the audit tax do differ from the taxes paid by the RO shall discuss the variation with the Tax Bureau. Finally, an RO will need to submit an annual report to the company registration authorities, the AIC, differing slightly from the annual report for the WFOE or JV. This RO annual report will need to include an audited expenses report.
Great. Well, thanks very much indeed, Ines. I think that's all we've got time for today, but I once again like to thank Ines Liu from Des Shearer & Associates for that very comprehensive rundown of the accounting and tax considerations foreign companies should have when they start doing business in China. Thank you, Ines.
Thanks, Graham.